We are also raising our outlook for our non-GAAP full-year diluted earnings per share, which is now expected to be approximately $1.80 plus or minus 5 cents. This is up from our prior outlook of $1.60 plus or minus 10 cents. And finally, our non-GAAP diluted share count is now expected to be approximately 54 million shares for the year. Due primarily to changes in our geographic mix of our earnings, we are lowering our FY25 non-GAAP tax rate to 25%, which reflects currently available information. While we expect to use this normalized non-GAAP tax rate through 2025, the long-term non-GAAP tax rate may be subject to changes for a variety of reasons, including the rapidly evolving global and U.S. tax environment, significant changes in our geographic earnings mix, or changes to our strategy or business operations. Our outlook for fiscal year 2025 is based on the current environment, which contemplates, among other things, the global macroeconomic environment and ongoing supply chain constraints, especially as they relate to our advanced computing and optimized LED businesses. This includes extended lead times for certain components that are incorporated into our overall solutions, impacting how quickly we can ramp existing and new customer projects, and higher tariffs in our optimized LED business. We believe we are continuing to manage our operations in a prudent manner as we navigate a challenging environment while also investing in our long-term growth. Please refer to the non-GAAP financial information section and the reconciliation of GAAP to non-GAAP measures tables in our earnings release and the investor materials on our website for further details. With that, operator, we are ready for Q&A.
Thank you. We'll now begin the question and answer session. If you would like to ask a question, please press star followed by 1 on your telephone keypad. If for any reason you would like to remove that question, please press star followed by 2. Again, to ask a question, press star 1. And as a reminder, if you are using a speakerphone, please remember to pick up your handset before asking a question, and we will pause here briefly as questions are registered. The first question is from the line of Kevin Cassidy with Rosen Securities. You may proceed.
Yes, thanks for taking my question. Congratulations on the good results. And in particular, the 5 new customer bookings. I wonder if you could give us a little more details on that. Are these customers that you got through partnerships? Maybe how long they've been working on booking these new customers, and is it software and services or hardware or both? Maybe just a few questions about that.
Hey, Kevin, thanks. It's Mark. Let me see if I can break this down for you. The length of these sales motions typically are in the 12 to 18-month range from the time we engage a customer to the time we ship, and the bookings kind of come somewhere around the 12-month mark. And I would say some of the new bookings were kind of along that framework. And you asked specifically about software and services relative to hardware. And we've mentioned on previous calls that the hardware is typically something that we recognize revenue up front. And the way software and services, that category is recognized as more ratified over time. And so when we get these bundled solutions, so to speak, these integrated solutions of hardware, software, and services, they typically are hardware upfront and have characteristics of being lower margin in nature. And then the software and services come to us over time. And that's consistent with some of our more recent bookings.
Okay, great. And maybe you said a little bit about the SK Telecom collaboration is coming, maybe generating new customers. Can you talk more about where you're seeing that? Which geographies or what kind of customers?
Yeah, absolutely. At the time of the investment, when we closed it back in December of 24, we highlighted that this was really a relationship that was transcending, the financial investment element of it. And we were excited about working with SK and more specifically SK Telecom and SK Hynix. We've had some early wins on the memory side, and we look forward to broadening that relationship with Hynix over time, more system-related products and helping enable some of their memory technologies to new application environments. We've talked about higher bandwidth opportunities like the OMA we mentioned. But we've actually had some early success on business opportunities with Hynix to date. We are making really good progress with SK Telecom as well. We are certainly very optimistic about the opportunities ahead with them in terms of the AI data center infrastructure solutions. By the way, the efforts that we have there are really global in nature, not just domestic, but also in other parts of the world. And we're pleased about the progress we're seeing on their AI data center initiatives, and we're exploring multiple joint opportunities with them. So overall, the relationship with SK is positive, and we're pleased with the progress.
Okay, great. Thanks for answering the question.
The next question is from the line of Tom O'Malley with Barclays. You may proceed.
Hey guys, thanks for taking my questions. My first is on the memory side. I think that's the one segment that you're actually taking a bit higher for the full year. You saw some strong growth in the May quarter. August for your full year guide is implied kind of down in the mid-single digits range. Can you kind of talk about the dynamic of potential pull forwards? If we look at some other companies in the ecosystem, you've seen some really strong consumer demand in the most recent quarter. You didn't call that out. You kind of called out a broad breadth of strength, but do you know if you're seeing any pull forwards? Are you protecting against that with the guide in August? Any color there would be helpful.
Sure. And Tom, I think just one correction. I think if you said that memory was the only one that was growing in the year, did I misunderstand?
No, you raised memory from, I think, prior, your range for the full year, I think, moved a little higher from 25 to 30%.
Correct.
So you took that up
Correct.
a little bit.
Right. Okay. Yeah. And advanced computing is up in the range. I guess it's 15 to 25%, I believe. So on the memory side, we are not seeing any necessary pull forward, so to speak. As we commented on back in the fall, there was some inventory that we were working through, and this quarter, I think we were really pleased with the growth opportunities as people started to get back in ordering, but we don't see any significant inventory builds or what have you. And yeah, we watch that from a customer discussion standpoint on their ordering patterns and what their requirements are and their forecasts. And our pipeline in Q4 remains pretty healthy. So we're generally very pleased with the direction of the business overall.
Helpful. And then on the advanced computing side, historically these are big projects, big customers. They tend to slide around 1 to 2 quarters, which is why I think the full year guidance is useful. But when you look at the fourth quarter, is the big acceleration again a timing of an order, or are you seeing kind of broad-based strength across different customers? Kind of implied in your full year guide is a nice mid-teens growth sequentially into the August quarter. So just trying to understand what's contributing to that strength in Q4.
We're doing, as we mentioned, we're seeing some uptick in terms of bookings, some of which we'll be looking to recognize the revenue through deployments by the end of the quarter. But this quarter isn't necessarily one major deployment. That's not what we're suggesting. We've got a little more diversity in the quarter, although I'll let Nate talk to the specific outlook. But this quarter is not like we commented on in Q2 earlier in my script. This is more a number of customers. And again, we run into the situation where the bookings come at a certain time, our supply chain goes out and acquires accordingly, and we look to install, and it's really done at the customer and our pace relative to the business we do with them, and not necessarily to the end of a fiscal quarter. So this is where we run into that same lumpiness in terms of revenue. Having said that, as I want to reinforce, it's not about one customer per se. It's a little more diversified.
The next question is from the line of Samik Chatterjee with JP Morgan. You may proceed.
Hey guys, thanks for taking my question. Maybe if I can start on advanced computing, and you talked about sort of the deployments for fiscal 4Q not being driven by like one lumpy deployment, but more broad-based. But can you talk about the mix a bit in terms of what you're seeing in those incremental deployments? And I know you've talked about the neo cloud opportunity, but any sense that you can give us in terms of what you're incrementally seeing in the mix sort of rotating more towards the neo clouds, or any more visibility as you look forward into that? And I have a follow-up. Thank you.
Sure. I think as I commented on earlier in my prepared comments, we've seen, in addition to neo cloud, we've seen some strength in federal and energy, had a win in biotech, and we're seeing a lot more inbound signals relative to interest in the financial sector as well. Those are kind of the top segments that we're playing in today.
Okay, got it. And then maybe on the sort of, I know it's too early to talk about the next fiscal year, but when you think about sort of the new customers that you've signed up, that you talked about, the 5 new customers, as well as the opportunity that you're now seeing in the pipeline, just help us think about maybe from a fiscal 26 perspective for advanced computing, what should we keep in mind relative to fiscal 25, the growth rate that you have in that sort of 15 to 25% range? How should we think about what are the puts and takes for fiscal 26?
Yeah, unfortunately, we're not providing any of that guidance today. It's too dynamic an environment with all the puts and takes. There's a number of factors that we and other companies are dealing with right now. One good example is the tariff situation and how dynamic that changes over time. Certainly, very happy and proud of the way the team navigated that in Q3 and delivered strong results. But we're gonna stop from commenting on FY26 in any way, shape, or form today.
Okay, no, I appreciate it. Thank you. Thanks for taking the questions.
Thank you.
The next question is from the line of Nick Doyle with Needham. You may proceed.
Hey guys, thanks for taking my questions. First, could you give any details on the CDW agreement or partnership? Just maybe talking about how that approach is different than with Dell, and if you expect any kind of similar contributions or customer type wins in fiscal 26. Thanks.
Sure. Again, sorry, Nick, we're gonna hold up on any 26 commentary, but the framework that we're working on right now is we're starting to invest in partnerships outside of our direct customer engagement, and you've mentioned 2 of them today. The idea being that we can scale to a larger set of customers through some of these partnerships and really focus on our value add. And we've seen some early proof of concept success stories in both partners that you mentioned. But again, it's early stage, and it's the right thing for us to be thinking about as we expand, not just in terms of customers here in the U.S., but as we think about a broader go-to-market internationally.
Got it. And for my second question, services revenue grew quarter over quarter, while overall advanced compute declined sharply. So was that driven more by these point-in-time services, or did those larger hardware deals in the first half translate to this, kind of slower, steady revenue growth that we saw this quarter?
I think that it's a mixture of everything. What you just said, it is a mixture of service revenue ratified over time and recognized over multiple periods, so to speak. And the mix of hardware in Q3 was lower than say Q2, and so the combination of that contributes to the services mix. As you know, we recognize services the way we do, but they are renewed annually. And then in the middle of the fiscal year, if we get a new order, we begin that recognition at the time of a shipment/signed order for those services. And so that's a positive, and we continue to try to add to that quarter to quarter.
Thank you.
Brief reminder, if you would like to ask a question, please press star followed by 1 on your telephone keypad. If for any reason you would like to remove that question, please press star followed by 2. Again, to ask a question, press star 1. And as a reminder, if you are using a speakerphone, please remember to pick up your handset before asking a question. The next question is from the line of Brian Chin with Stifel. You may proceed.
Hi, this is Dennis on for Brian. Thanks for taking our questions. My first one's on advanced compute. So for the 5 new customers that you won, are you expecting any change in the hardware and software mix proportions over the life of these customers?
Well, typically what happens, or what we've seen happen with our customer engagements with new customers, is again the revenue recognition for the new customers up front is hardware related, just because that's what we install and that's what we design a solution for. And then our services and software mix happens over time. Now, we've had a number of instances where customers increase the footprint of their rollout or of their implementation, and that can be a time when they actually order more hardware along the way. But typically, the flow of revenue recognition and type of product is hardware early on in the cycle of a new customer acquisition, and software and services over time. And we continue to try to be very disciplined and making sure that we're not doing any hardware-only deals. As you all can see from our competitor announcements, without being specific, the hardware market itself is super competitive from a margin standpoint. And quite frankly, I think our value add is in the services area, in the software and services that we offer our customers. And of course, our hardware is best in class from a design and performance standpoint, but the hardware market tends to be lower in gross margin, and thus we tend to propose and look at our business from a solutions mindset, not in any one component of hardware-only sales.
Would you say that the majority of this $66 million of software services sales comes from advanced computing, or is there a good bit from the other segments too?
A majority of the services, like a healthy majority. I'll let Nate see if he can give me the actual number here, but the majority of services is all advanced computing.
Yeah, the great majority. Got a little bit in memory, but it's really mostly advanced compute.
Great. And then for my second question, so for memory, could you discuss the strength in this quarter from a product and vertical perspective? And how does the strength in DRAM pricing impact your memory gross margins? And maybe you could also talk about the attach rate of your memory products to your advanced computing products.
Okay, so the first, the pricing in DRAM has been relatively stable in the quarter. What I would say is the memory gross margin question, ironically, when memory pricing goes up, the gross margins are impacted slightly in a negative way because DRAM then becomes a higher percentage of the whole value add that we give. But it's just a directional trend. But the mix of products and the unit growth was substantial as well in the quarter, which led to a combined high growth quarter in memory. On the attach rate, we continue to work and use Smart Modular in the Penguin platform that we do sell. And we're continuing to develop on new products that we think will be very valuable in terms of the AI ecosystem, as we've talked about, CXL and our optical memory appliance development, which is a long-term initiative for us to help provide better memory, advanced memory solutions for advanced workloads. So it is a priority of ours, and we do a good job on the Penguin systems itself, and we're looking to develop more sophisticated, higher bandwidth memory end products going forward.
That's it for me. Thank you.
Thank you.
For our last question, we have a follow-up from Nick Doyle with Needham. May proceed.
Hey, thank you. Just kind of a bigger picture question. We're hearing about this idea of production inference, and I think that really requires this truly tier one grade, high availability, server solution. So if you take out the hyperscalers just because that's not where you generally play, how much market capacity today is operating at that level and kind of ready to service production inference? And, how much is left where you guys can go in and really increase that utilization, get the high availability ready to go? Thanks.
Nick, I'm not sure I totally understood your question. We have a high availability edge server platform that we use. We've talked about developing products for inferencing over time. In the data center, we're starting to see more of the trend line to be a hybrid training and inferencing demand thesis, but I'm not sure, again, if I'm quite getting your question. Can you restate it?
Yeah, just pointing out that when guys want to do this kind of production level inference, there's this thinking that it really requires high availability versus more traditional cloud. And to do that, you need a higher level server, and that's what you guys can provide. So maybe the market just isn't there, and you can kind of help the market move towards a solution that, works for everybody. And wondering how much.
Great. Got it. So I understand. I apologize. I misunderstood because when you said inferencing, I initially went to our edge platform and what we're trying to build for future edge implementations. But in the environment you're talking about, you're exactly right. And by the way, that's has to do with our software and services that we provide to be able to make sure that not only is the design performance we get up front in our systems critical, but it's also the availability and uptime through diagnostics and fault repair capabilities in the data center that allow us to have the maximum uptime. And that's a really critical metric when you think about the capital investments into AI infrastructure, making sure people have high reliability, high availability, along with the high performance. And quite frankly, when you come from a high performance compute background like us, we've seen the levers that allow for the most optimal performance in a data center. And I think that has played well and will continue to play well for us as true enterprise rollout production environments for inferencing.
Thanks, Mark.
Thank you.
That concludes the Q&A session. I would now like to pass the conference back over to Mark Adams, the CEO, for any closing remarks.
Thank you, operator. And just in closing, we are pleased with our results through the third quarter. On today's call, we reconfirmed the midpoint of our revenue guidance, which we raised to 17% on our last call. And we raised today our earnings per share guidance range for fiscal 2025. We have strengthened our balance sheet and remain committed to our long-term investments in hardware, software, and services, positioning us to address the rapidly growing market demand for AI infrastructure solutions on-premise, in the cloud, and at the edge. Thank you all for joining today's call.